Hello, everybody. Thank you for joining us in our first virtual Lunch and Learn here in the office. My name is Carl Frank, President of A&I Financial Services. It's a pleasure to have you here today, and I look forward to talking to you today about our September 2020 Economic and Market Update. So here's where we're going to go. We're going to introduce our firm real quickly for you, and then we're going to talk about four big themes that are driving investment markets and the economy today. Then we're going to talk about three investment ideas that we have for you, and then we're going to wrap it up. So I sure hope you're looking forward to it half as much as I am looking forward to giving it to you. Let's get started. First of all, our firm. You know, I've never worked with a greater group of people than we have here today. We are a small group of people, and we're just a hardworking group of people who are down to earth and experienced. You know, amongst our team, there's more than 100 years of investment experience, and the average is significantly closer to 20 years of experience than it is to 10. So it's a good group of people that we're working with. Never worked with a more caring group of humans in my entire life. One of the things that makes us unique is our expert team. We've got an unbiased expert team, and if you've got a series of CPAs or attorneys or other people who you work with, we can work with them, and our process makes it easier so that you can just drive your retirement ship and not have to worry about all the pistons firing in the right order. We'll make sure the estate and the taxes and the trusts and the insurance and everything are all working for your best interests. The third thing is our patented investment process. We use the Athena patented investment process. It's very unique to us. We feel privileged to have the opportunity to introduce a little bit of that to you today. The vast majority of that we covered in a prior Lunch and Learn, so please look for that on our website. The fourth thing is you, and we only work with a small number of successful families just like you, and I am so thankful to have you as our extended family and friends. Finally, this firm operates with a spirit of humility and gratitude. I sure hope you see that in today's presentation and in every experience with us. We're very proud of what we know, and we know there's a lot more that we don't know. And so we're always searching to improve ourselves and increase our body of knowledge and partner with people who have the expertise that our clients need so that you can succeed at your retirement journey. What a world we're living in. Oh my goodness. The news every day is crazy. Here's the bottom line. Here's the conclusion for today's seminar. We're in better shape than almost anybody believes, and the only thing that matters is what the vast majority of people believe. The people believe today in fear. We're scared. We're nervous. I'm going to talk about these emotions that are driving the world right now in a big way in a little bit, but that's the bottom line, that we're not in that bad a shape. I'll show you the reasons why I believe that here in a second, and then I'll talk at great length about what's really driving us, and it is our emotions, which we can change, but it's the collective emotions of the entire world, particularly the American consumer, that matters the most, and right now they are mixed, to say the least. The news has never been worse. Oh my goodness. This chart is very hard to read because that big line, that red line right there, is huge. It's off the chart negative. We've never had a single quarter drop as quickly with our gross domestic product in the United States of America ever as we did just recently. It happened faster and deeper than any time in history. Even the 2008 crisis looks like a blip compared to the 2020 COVID-19 crisis, which, quite frankly, we've already come back out of according to many, many metrics. So that's the reason why at the concept, we already know this. I mean, you know, ask any economist and he'll tell you the obvious with a whole bunch of confusing numbers to prove it. That's what we're looking at today. We're looking at a COVID-induced crisis, and it's been big. So no wonder we're rattled. And on top of that, we've got other things that are going on in the world that made worse. The China and U.S. relations are getting more and more dramatic than they ever have been, and that could be a problem. And that's going to unsettle markets, that's going to unsettle the economy. The second big thing are the elections, and from now until November, we're going to be inundated with negativity from both sides. It's exacerbating the stress, and even after the November elections, there are fears that may be well grounded that we might not know the results and it might be a contested election. And we've seen that before. We've been through this before. It's not going to be hanging chads. It's going to be something along the lines of guaranteed signatures with mail-in ballots. I don't know. I'm not making a prediction short term about that. But the market is predicting some wild rides between here and the beginning of next year. So buckle up, because the elections are a dramatic upset for what's going on. As if that wasn't enough, we've got massive social unrest, and the Black Lives Movement and other important movements that are going on in our country right now are going to continue to distract us. They're going to continue to stress us out, and we're quite frankly reaching a point where we don't know if we can take it anymore. You know, when your stress level gets up really high, even the smallest thing can set you off emotionally, and sometimes we take action on that. So before you think about acting on your portfolio, make sure to talk to your financial advisor, because these are times when it takes a second set of eyes, if not a third or a fourth. And of course, a team like us, we've got a lot of eyes to look at it and make sure that we're making the right decisions for the real time frame that matters the most for you. And finally, corporate earnings, and they were horrendous recently, but I've got a silver lining to this storm cloud, and that is that if I'm a corporate executive in charge of budget and I'm confident in my company, and I'll show you a statistic here in a minute that says the vast majority of CEOs are confident in their own company, even if they're not confident in the world, in the US, they are confident in their own company. Well, in any event, if I'm that man or woman in charge and I've got an excuse like COVID-19 where I can sabotage my earnings this quarter to make very good business investments for the long haul that are going to set me up for a great earnings rebound, I'm going to use it. And I have a suspicion that a number of very savvy CEOs and CFOs and other corporate executives of some of the biggest companies in our country have done that. And a lot of that money went into technology to help them be more productive and more efficient in the future. And so there's a silver lining actually to all four of these, but the last one most specifically affects the equity markets, and that might be why equity markets have rallied back so strongly since the March 23rd decline. Now, here's what's going on in the economy. We use an academic research approach. Athena Invest puts together what they call their market barometer. You can see this on their website anytime you want. This is the most recent at the time that I could present. They may have a new one right now for September, but in any event, it probably will look pretty similar. They divide it into 4 categories, and for each category, there are multiple things. And the bottom line for all of these put together is that things look average or slightly better than average. Over here, you've got the behavioral market indicators that are patented by Athena, and they're all saying things are okay. The next category beside them are the economic, and believe it, there are 2 big indicators that have been academically proven over decades, and they're both very strong. They've come rallying back very strong since the crisis, and I looked at them just very recently, even since this, and they're even stronger than they were when this was reported. Beside that, we've got the valuation indicator, and that's really interesting because it looks like it's bad, but that happened because, again, corporate earnings tanked and the equity prices skyrocketed, and so of course things look overvalued. And what you'll hear often and get very confused, and it's a very confusing message that Finance Yahoo or other places will send to you, is that the markets are overvalued, it's worrisome, should I sell? Valuation is a horrible indicator for timing. Don't use it. It hasn't worked, and it's likely not to work in the future, because all this is showing you when it's overvalued is that things have gone up a lot quickly, and of course they have. And finally, the technical indicators are ways to look at the equity markets, and they're all in the green because markets have gone up very quickly, very recently. So overall, using these academic researches, which I think are pretty doggone solid, and we use at our firm just to get the baseline, things are average to very good. Average to very good. But again, the only thing that matters is what everybody believes. It doesn't matter what the average or very good underlying fundamentals might be. We feel bad. So here are the 4 big drivers of today's economy and markets. The first one is changing consumer demand. 3 big charts I smooshed into one here. This research comes from McKinsey, and the first we already know. The first is that consumers are moving online fast. We're ready to go online faster than we ever have before. The second, you might not know, but you're probably living it, because I know my family is, and that is that we're not brand loyal nearly as much as we're used to. We are able to switch brands faster than ever before. As we go online and we look on Amazon and we see this product is $1.09 cheaper than that one, we're like, it really doesn't matter that much. I will go $1.09 less, which means merchandising, which is happening at the grocery stores when you look at all the shelves, is becoming of less importance. And so that leads to the third big thing changing demand in our country right now, and that is that there will be less products on the shelves, that consumers are changing their behavior. They're becoming more domestic. They're spending more time shopping online or not. They're spending more time traveling within a small area than they are international traveling, obviously. So three big things are affecting demand, and that's changed the whole world, or at least the economy in America, which largely depends on consumers. The second big driver is the changing workforce. We're all working at home, and we need to reskill. And it's particularly hard as parents of high schoolers and college-age kids like we are. These teachers need to reskill, and it's very hard to do. It's not easy for them to make the change from the classroom to the online computer screen. And there's a big social divide going on in our country between the pajama class, the people who can actually work at home, and the frontline workers who can only do their work at home. In fact, the pajama class is becoming more and more numerous. These three charts are showing you what it looked like before COVID. 1 out of 5 people worked at home, and then all of a sudden in May, more than half of us started working at home. It's a huge change in the workforce in America, and there's a bigger divide, and the frontline workers are not at all happy about that, and the pajama class has to reskill themselves, and they're not really comfortable with it either. So these are unsettling. The changing workforce is a very unsettling thing. The second thing going on with changing workforce is the way businesses are actually doing work. In this chart on the right, companies are divesting assets. They're looking at things and they're saying, we don't need those. We need to build up cash. And so this big chart with a big graph, again, out of the range of any quarter that's ever happened in the past, companies are divesting assets and they're building up capital so that they could sustain themselves through the crisis. Well, that means some of the big companies are becoming smaller. They're divesting and they're selling off some of their divisions that maybe aren't integral to their plans. And so related to that are the second chart were these big horizontal graphs, and that's saying there's going to be less products on the shelves. Companies are focusing in on their most profitable products, and they're going to have less choices to choose from. Off-brand products are a big theme for a number of the money managers who we use in our client portfolios. So look for that and see for yourself if that makes sense, because a number of our money managers are making decisions that way, and we think they're pretty smart. We think that's definitely what's going on. All right, the third big theme is what we already know, and that is related to regulatory uncertainty. What's happening in our country is terrifying for businesses. If the goalposts are moving, it's hard to play the game. In fact, a lot of the games are just flat out being canceled. This chart is showing you here that the amount of money spent to fight COVID-19 is 3 times the size of the amount of money spent during the entire 2008 crisis. It's huge. It created a massive budget deficit, the likes of which America and the other countries in the world have never seen before. But the bigger side of that is that, all that benefit really backstopped this, and something that the Federal Reserve did that bottomed the market on March 23rd was said, we're going to back up everything. Nothing is going to fail right now. We're going to make sure that we get through this crisis, and all of a sudden the market started to rally back. So that's fine, but the regulatory uncertainty is huge, and that's causing a lot of changes for companies. They've got a moving playing field, and it's hard to play by the rules if they're always changing on you. And that's, part of that is the crisis in China, or the protectionism and the populism that is rampant around the world with various countries. And you can be for the working person and not be against world trade. But right now, it's all the same thing. And all of the candidates in America right now are more populist than they have been in a very long period of time. And it could lead to protectionism, which could be hard for large companies to continue to make money. It could be a situation that is great opportunity as China starts to separate separate from its need for American dollars in order to keep all of its people employed and keep growing its economy, as it separates, there could be an investment opportunity. I'm giving you a forecast here in a minute. And again, the stimulus package is a massive float. It helps all these boats rise. And there's been great concern in our country about where that money's gone. I'm going to show you in a minute that there's a huge amount of money out there and show you the downside of that, which could be inflation. So those are the first of the three big themes. The fourth theme driving the world is by far the biggest, and that's COVID-19. It varies country by country. Sweden famously did its own thing, and I got to tell you, it's completely political which side, whether you believe the Sweden decision was right or wrong. Everything in the world is politically divided right now. It's hard to find reliable statistics. They'll be slow, they'll come out. We'll have to try and do our best to make a rational decision with the data that we get. But right now it's politically divided and divisive, and it's unreliable all over the place. But the truth is, the second bullet point, and this is how I'm optimistic, another way that I'm optimistic, is that we're increasing our understanding of COVID-19. And the more we understand it, the less fearful we will be. And eventually our moods will change. Eventually the collective understanding of all of us together will decide, I understand this, I understand the risks, I can put it in place, and I can look a little bit more at the fundamentals. And again, the fundamentals look good to great. And so there's all sorts of reasons for optimism. The biggest driver is how we feel. And right now we're feeling bad because of the four reasons. In fact, we're feeling exhausted. Are you feeling exhausted? My school-age kids are feeling exhausted. These college-age kids are just going nuts. And you know what? Who can blame them? I mean, they don't have football anymore to watch, right? They haven't got what a lot of the fun parts of going to college give them. And they're being told not to do that. And it's completely difficult for them. It's a totally different experience. On the same side, opposite side of the coin, our senior citizens are being told to lock themselves up, and the world is dangerous. And so we're just driving each other crazy. There's mass psychosis going on in the world right now, and eventually the increasing understanding will bring it to an end. But those four themes are the big drivers of the world today. And Guggenheim says it doesn't matter what the governments do all around the world. Eventually fiscal, which comes from the government, and monetary, which comes from the central banks. I'm going to tell you that they're basically the same thing for reasons that are a distraction. All of that doesn't matter, because ultimately the only thing that matters are two things outside of our control: when we're going to get a vaccine and when we're going to get a therapeutic for COVID. And when those happen is completely outside of our control. But I'm optimistic again, because never in my life have I seen all of the organizations in the world, all of the NGOs, all of the government organizations, and all of the companies in the world working in the same direction. And it's happening now. And so it will happen. I'm optimistic that it will. It'll happen faster than it's happened before, and it'll be great when it happens, and eventually we'll finally put this to bed. But in the meantime, COVID is the big upsetter, and COVID will be the determinant. And so this research here comes from McKinsey, and a lot of the stats I just showed you came from McKinsey. McKinsey is a international research firm, a consulting firm. They work with the world's largest companies. Companies write them $1 million checks to tell them what they're doing and what they can do better. And what McKinsey did was survey the CEOs of a large number of these companies around the world, and said, what do you think about two things? What do you think about a number of things? But the results came back. The CEOs are confident in their companies, but they're uncertain about the governments, and they're uncertain about the economy as a whole. They're uncertain about the pandemic and how long it will take. And so from that survey, McKinsey brought it into a chart that looks like this. It says McKinsey, the vast majority, according to McKinsey, the vast majority of CEOs in the world, their forecast looks something like a long and delayed recovery economically, a faster possibly than expected pandemic medical response. And so we might be looking several years, if you look up and down this grid, for different parts of the world, for when the GDP will be back to what it was in February before the pandemic hit. So we've got a few years of economic malaise, but that doesn't mean market malaise. It does not equate. The stock market clearly is way up. It's predicting a faster end to this crisis than almost all the pundits and everybody else in the world. And it could be that the market's right. Big money's betting that way. Here's some of the downsides of what happened. When you put so much money into the market, a secondary effect might be inflation. And so, again, off the charts, we've never spent so much money so quickly. The blue line is showing you the massive amount of money and how quickly it was pumped into the economy by the U.S. Federal Reserve. The red line, orangish red line, is way down. The red line is a measure of how quickly that money is moving through the economy. The red line is near all-time bottoms, while the blue line is near all-time highs. If that money were to be put to work and spread all throughout the economy, there could be inflation. That's the classic monetarist Milton Friedman belief, is that it's always about money. Inflation everywhere is always a monetary phenomenon. Well, right now it's not moving, and so we don't have inflation. And perhaps maybe that will come. And that will be a downside to what we're talking about. So we have to invest smartly when we're looking at a world where inflation could be looming. And I'm not saying that it is. One of the biggest reasons that it's not right now is because we still have low interest rates. And this chart is old because it's showing that some of the Federal Reserve, it's showing each dot is a Federal Reserve chairman making a decision to keep interest rates low. And it's saying that some of them actually might perhaps maybe want to raise it. Not anymore. It's unanimous. The Federal Reserve is going to keep rates low for the foreseeable future. Interest rates will remain low for the foreseeable future. And the Federal Reserve is saying, we're not even thinking about raising interest rates. So that's an interesting world, because if we've got zero interest rates effectively, and we've got very, very low inflation, where are we going to invest? We're not going to get big returns from other places, and so money will continue to go where it's gone recently, and that's into equities. So let's talk about what we see. We see three big opportunities for equities today. And we're going to look at history, and we're just going to use our guide, and we're going to say it's not the most perfect timing device, but it is just plain old common sense. In today's world, the largest companies have left behind some of the smallest companies. I'll show you a stat in a minute. It's from a Periscope a week ago. Some of you will remember the age of big tech Periscope. Go look it up on our website on the blog page. Read about it. It's astonishing. But some of the companies that have been left behind are a great opportunity for us. And we are going to keep a little bit of money in some of the companies that might look like laggards on your investment portfolio. And they're called valuation. It's a type of investment strategy. When I spoke a month ago, when Chad, Brett, Stacy, and I spoke a month ago about how we manage money here, the right way to invest in equities is to diversify by strategy. And one of the strategies is called valuation. It's like Warren Buffett, where you buy companies inexpensively, and over a long period of time, and sometimes short period of time, you make good in returns. And that's the idea. You get a margin of safety, and that's the hope. Well, that's what we're going to do. The last time that the biggest divergence between a future growth style of company, like the ones that have killed it this year, and the valuation companies, the ones that have not grown or might even have lost equity value this year, has never been this big. The last time that happened was 1999, and it turned out to be a great opportunity, because you'll see the table chart, the charts flipped, and all of a sudden that valuation style was very much in favor compared to the technology style, which went out of favor. So we're going to be a little bit humble, we're going to be a little bit smart, we're going to be a little bit patient, and we're going to have a little bit of money in the companies that most recently have not done well, because it's always been the case in the past that style of strategy comes back into favor and does very, very well. The second big thing we see right now is international. Again, for similar reasons to the valuation strategy, U.S. companies have done very, very well, and the rest of the world has kind of been left behind. This chart shows emerging markets, the smaller countries in the world, which for whatever reason, a lot of people still lump China, the second largest economy in the world, into an emerging market space. It's irrelevant for our purposes. We're going to have a little bit of money in a large number of international places, and there's a great opportunity there. Think about it this way. If you've got two sweaters that you want to purchase at the store, they're the same sweater, same quality, they'll keep you just as warm. They're made from the same wool. One is full price from an American company, and the second is a fraction of that price from another country. which one are you going to purchase? Well, the truth is that we have purchased in the past that less expensive one from another country. It's the same quality, delivers the same usefulness, and will buy things on the cheap. It's just like shopping Nordstrom Rack instead of Nordstrom's. Well, except that maybe they're not even the secondhand shortcomings that the Nordstrom Rack advertises. Well, in any event, that's what we've got right now. We've got sweaters that are half price, and so we're going to put a little bit of money there. And international is a great opportunity for the long haul. When we look at all of these investment themes that I'm talking about here, what we're looking for is areas that have done well in the past that most recently have not been doing as well, where we have a good opportunity in the future to do better. So the third investment theme might be counterintuitive, because I'm going to talk about that periscope from a few weeks ago. In 2005, the largest companies in the world were up here on the screen, and you've heard of these companies. You've got GE, ExxonMobil, Microsoft, Citigroup, BP, Walmart, Royal Dutch Shell, and Johnson & Johnson. They were the largest companies in the world, quite frankly, and they were here in the US, all of them. And then all of a sudden, 15 years later, the tide has turned. Those companies have still grown, but look at who the largest companies are now. All of those companies put together don't equal Apple. The second largest company isn't one of our companies, it's Saudi Aramco, a huge oil and gas firm, right? But the rest of them are technology firms, and the smallest of the huge companies are firms that were barely around back then. Facebook, and Baidu and Tencent, two Chinese technology firms. The rest are companies the Googles, the Amazons, the Apples, the Facebooks, the Microsofts. These companies have gotten huge this year, unfathomably large this year. $2 trillion valuations, where years ago the largest was $200 billion. It's factors larger. And my point to you is that the next 15 years, we don't know exactly which companies are going to kill it, but my money's not on the companies that already have. We have downplayed some of the biggest technology companies, and we're putting money into places that our money managers believe will likely have the better chance of doing better in the future, and perhaps maybe become one of these big companies that you see right here. And so smaller company opportunities, valuation style companies, and international style companies, those are the three big investment themes we see right now. We're taking advantage of those, and we think over the long haul we're going to be rewarded. The bottom line is, folks, we're in better shape than almost anybody believes. But the only thing that matters is what everybody believes. And so until the collective emotions of the world, especially the U.S. consumer, change for the positive significantly more, we're in for a wild ride. And an election year is always a wild ride. Last week, the S&P 500 and the NASDAQ and other markets crashed precipitously. I can't explain exactly why that happens. I'd be making up a reason for that. Lots of experts were on the news making up reasons for that. Some of them blamed the millennials who are trading on Robinhood, who posted 70, 80, 90% losses in their portfolios because they're buying things they had no idea what they were doing. And all the options markets and everything. Other people said it was just due. I'm more inclined to say, that's the equity market. And if you're worried about a one-day decline, we really need to talk, because that's not the place for you. And so we want to align our investments with the right time frames. And at our firm, we recognize that lots of things are out there that can change the way we look at the world and can change our perspectives very, very quickly. And so we take an approach for the long haul that's quite different, perhaps, than what you might hear about from a marketing firm or a website or anybody else. And the number one determinant of your financial success is your behavior. It's investor behavior. And the best way to handle that is a real life financial plan with a planner, so that you can take the right asset allocation, make sure you've got the right amount of money in equities and not more than you need, and the right amount in other investment assets that can help you achieve your true real life long-term retirement income and other financial goals. When we're investing in equities, they will be, we believe, the longest, best determinant of your real life financial success. And when we invest in equities, we believe the right way to invest in equities is to diversify by strategy, because we never know exactly when future growth style companies, the ones that have done so well this year, will suddenly stop doing well, like they did in the year 2000 when the dot-com and telecom crash happened. And all of a sudden the valuation style companies start doing significantly better. And so we want a little bit in both of those. And as we've talked about before, there are 10 strategies, and we're going to have our money in a handful of those, maybe 5 or 6. And finally, we remain humble and remain grateful for your trust in us. We're always learning, we're always improving, we're making changes, even if they're invisible to you. The work here never ceases. So I want to thank you for your trust. Behind me are some of the sources and some of the disclosures. I'm not making any promises, of course, about future returns or even telling you that the economic forecast that I'm giving you is 100% accurate. There's liars, damn liars, and then there's economists. And the only thing worse than a professional economist may be an amateur. And I'm not even telling you that I'm an amateur. I'm a financial advisor and a financial planner reporting to you what we're doing in today's world. And so I appreciate your time. I appreciate your attention. I greatly look forward to talking to you. Call me, call your financial planner at any point in time, and let's talk about what this might mean for you. Until then, create another beautiful day. Bye-bye.